Dmart has been a retail giant in India for over 20 years. Now, if you've ever visited one of their stores, you know the deal. Great prices, tons of customers, and a retail model that's become iconic. But now, after ruling the market for so long, we are seeing some challenges arise. The main issue, quick commerce. Now, this new trend is changing the way people shop. Companies like Blinkit, Swiggy Instamart, and Zepto have realized that urban consumers want their groceries and daily essentials delivered fast, often in under 30 minutes. Now, this instant service is starting to take customers away from stores like Dmart. Now, Dmart's whole success is built on people coming to their stores, buying in bulk, and getting those savings. But now shoppers are asking, why bother driving to the store when I can get the same stuff delivered at home fast? So, Dmart now faces big questions. Will it adjust to this fast changing market, or will it stick to its old ways of running large stores? Now, can Dmart stay on top, or will quicker, more agile competitors take over? Let's discuss. You're watching Informed Investor, initiated by Equentis. Now, let's quickly talk about the business of Avenue Supermarkets Limited, or as we all know it, Dmart. Now, it is one of India's leading retail giants operating a chain of supermarkets and hypermarkets. The company was founded by none other than Radhakishan Damani, a name synonymous with smart investing and business acumen. Now, headquartered in Mumbai, Dmart has been growing rapidly over the years. As of September 2024, they've expanded to 377 stores spread across 12 states and union territories in India. Now, let's talk about Dmart's success. Now, Dmart has become one of India's most powerful retail brands because it mastered the basics of shopping: low prices, convenience, and trust. Now, first, Dmart really nails it on product selection. Instead of filling their shelves with every possible item, they focus on products that people buy frequently, things you would find in a typical monthly shopping list. Now, by doing this, they keep their inventory moving fast, reducing the risk of items sitting around and costing them money. Now, Dmart has a high inventory ratio, which indicates efficient inventory management with products selling quickly. Then there's the own stores model. Now, most retailers rent their space and rents tend to go up over time, which eats into profits. But Dmart actually owns most of its stores, meaning they save a ton on rental cost. Plus, this keeps them protected from sudden rent hikes and gives them full control over store operations. Now, next, Dmart has a smart sourcing strategy. Instead of working with a bunch of middlemen, they buy directly from manufacturers. Now, this cuts out distributor costs, and it also means they can negotiate better deals. Now, they even place suppliers upfront, which gets them additional discounts, and these savings are passed on to customers. Now, then Dmart's whole model is volume driven. By selling essential items at low prices, they keep their sales high throughout the year. Now, high volume also gives them stronger leverage with suppliers, which helps them keep prices low and margins steady. Now, another important point is the no-frills store design. Unlike some of their rivals, Dmart doesn't spend a lot on fancy interiors. Their stores are simple, which aligns with their goal of keeping costs low. And that's a conscious choice that they would rather focus on passing those savings on to the customers than on decor. Finally, there's this cluster-based expansion strategy. Now, instead of opening a bunch of scattered stores, Dmart clusters new stores within a few kilometers of existing ones. Now, this way, they strengthen their brand presence in each area, and by having stores close to each other, they can share logistics and resources, saving more money in the process. So, to wrap it up, Dmart's success comes from sticking to a straightforward, customer-first approach. By focusing on what people need, owning stores to keep costs low, buying directly, and running a no-frills operation, they can offer great prices consistently. Now, it's a simple yet focused strategy that sets them apart in the retail game. However, Dmart is now facing some challenges, and this has been reflected in the company's stock price, which is down more than 20% over the last 6 months. So let's break down the challenges that Dmart is facing. As we discussed in our intro, the biggest challenge is the rise of e-commerce, especially with the growth of online platforms like JioMart, Zepto, Blinkit, and BigBasket. Now, these companies offer the convenience of home delivery, which more and more people are running to. Now, here's some data to understand how big this trend is. Now, online shopping in India is growing fast because consumers want the convenience of getting things delivered straight to their homes. Now, some of the categories seeing the biggest growth are groceries, personal care products, fashion, electronics, and even pharmaceuticals. Now, these categories have seen impressive growth rates, with groceries growing at around 46% annually between 2018 and 2023. Now, let's focus on quick commerce, which is basically the ultra-fast delivery of things like groceries and essentials. Now, quick commerce has grown rapidly, jumping from just about 0.14% of the online retail market in 2018 to 4.8% in 2023. Now, this market is expected to keep growing, with some estimates saying it will make up 17 to 30% of online retail by 2028, potentially reaching a size of 2.3 to 4.2 trillion rupees. Now, grocery shopping was the first area to be disrupted by quick commerce. Today, online grocery retail has already reached about 31% penetration in the market. Now, compare this to the overall quick commerce market, which is at 4.8%. Now, this shows how much more growth we can expect in the groceries sector, especially for online services that deliver groceries quickly. Now, at the moment, there are several players competing for a share of the quick commerce market, including Blinkit, Instamart, Zepto, and BB Now. Now, this is a big problem for Dmart, as they're now competing with companies that offer much more convenience with home delivery. Now, Dmart has also noticed the impact of these online grocery services, especially in big cities. Now, even though Dmart has seen strong growth in the past, their like-for-like growth has slowed down. Now, like-for-like growth tracks the sales growth of stores that have been open for over 2 years. And in Q2 fiscal year 25, it dropped to just 5.5% compared to high single-digit growth in the past. This slowdown is a clear sign that their growth engine is slowing down, especially for older stores. Now, another issue Dmart is facing is its revenue growth per square foot. This number shows just how much money the company makes for every square foot of retail space. In Q2 of fiscal year 25, this number stayed stagnant, meaning they aren't making more money from their existing store space. Now, Dmart's inventory turnover ratio, a key metric that tells us how quickly the company is selling its stock, has also taken a hit in fiscal year 25. Now, it dropped from about 14.8 in fiscal year 23 to just about 6.6 in the first half of fiscal year 25. Now, what does this mean? Now, simply put, Dmart is holding on to its inventory for much longer than it used to. Now, this hints at a possible mismatch between what consumers are buying and what Dmart has stocked up on. Now, with quick commerce booming in urban areas, people are now leaning towards smaller, more frequent purchases rather than those big bulk shopping. So, this shift in consumer behavior is making it tough for Dmart to keep its inventory moving as efficiently as before. Now, currently, the impact of quick commerce is more pronounced in metro cities where the demand for convenience and speed is highest. Now, metro markets accounted for about 47% of Dmart's total revenue, and it is in these areas that the company is facing the most significant challenges. However, this threat may not be limited to metro cities. As quick commerce players continue to grow and invest in expanding their infrastructure, they're likely to target tier 2 cities where consumer preferences are also evolving. Now, the penetration of smartphones, increasing internet connectivity, and changing lifestyles are driving demand for convenience in these regions as well. Now, Dmart is also fighting competition from stores like Zudio and Reliance Trends, especially in the apparel segment. Now, the overall revenue from general merchandise and apparel has also fallen. In the first 2 quarters of fiscal year 25, GM&A contributed 23.45% of the total revenue, which is much lower than it was before COVID. Now, even though the business is stabilizing, the loss of sales in apparel is structural. Now, value-driven retailers like Zudio and Reliance Trends are making it harder for Dmart to attract customers in the hypermarket segment. Now, in summary, Dmart is facing tough competition from both e-commerce players and value-based stores. The company is feeling the pressure, especially in their older stores and in the apparel segment, and their growth is not as strong as it once was. Now, to fight off the competition from online retail and quick commerce, Dmart is also engaged in the business of online and multi-channel grocery retail under the brand name of Dmart Ready. It allows its customers to order a broad range of grocery and household products through its mobile app and website. Now, customers can either self-pick up their online orders from any designated Dmart Ready pickup points or get them delivered at their doorstep. Now, to fight off the competition from online retail and quick commerce, Dmart is also now engaged in the business of online and multi-channel grocery retail under the brand name of Dmart Ready. Now, it allows its customers to order a broad range of grocery and household products through its mobile app and website. Now, customers can either self-pick up their online orders from any designated Dmart Ready pickup points or get them delivered at their doorstep. At most of the pickup points, it also offers a select range of merchandise for instant purchase. Now, Dmart Ready continued to scale up with 21% year-over-year revenue growth in the first half of fiscal year 25 and about 32% growth in fiscal year 24. However, this scale-up is significantly lower than quick commerce despite the scale of the business being much larger. Now, one more thing to note is that for Dmart, adapting to quick commerce would require a shift from bulk purchasing to smaller, more frequent restocking, which could increase cost and erode the cost advantages that underpins its business model. Now that we've understood the challenges that Dmart faces, let's also talk about the strengths of the business. Now, number one is strong brand value and customer trust. Now, Dmart has cultivated a reputation as a destination for low prices and bulk shopping. Now, this trust isn't easily replicated by competitors. Customers value the no frills model that focuses on delivering cost savings directly to them. Now, Dmart's consistent service and inventory reliability have created a loyal customer base over decades. Now, let's also look at Dmart's financials. Now, Avenue Supermarkets operates with minimal debt, which gives them the flexibility to invest in new initiatives like Dmart Ready and adapt to market changes. Now, by owning most of its real estate, Dmart also avoids rental inflation, ensuring stable profitability even during economic downturns. Now, efficient inventory management also reduces carrying costs and minimizes wastage, which directly supports margin stability. So here's where it all stands. Now, Dmart, with its high volume, low cost strategy, has built a strong position serving price conscious consumers. But the rise of quick commerce focused on speed and convenience is challenging the traditional mode, especially in urban areas where consumer habits are evolving. That said, India's retail landscape is vast. Different formats, from Dmart's value-based approach to quick commerce hyper-local focus, will likely coexist for a long time. Now, large-scale permanent shifts in consumer preferences, that will take some years to unfold. But keep an eye on Dmart and the next couple of earning results, which will tell us how they will adapt or if they don't. And this could also tell us a lot about the future shape of India's retail sector. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.